What's going on, everybody? It is Spencer Gray, and if you are a multifamily investor, an aspiring investor, maybe you're an industry insider, or you just love this idea, creating passive income, generational wealth by investing in multifamily apartments. Get ready because you're in the right place. We've got a great episode today of the Gray Report, doing another newsletter roundup. So much is going on in the market. It is incredible. If you've been paying attention, you've been staying up to date. A lot of things we've been talking about, they're really materializing. So really exciting. So without further ado, let's just get into it. All right, first, just before we get started, a quick message from our sponsor. This episode of the Gray Report Newsletter Roundup is sponsored by the Suncrest Apartment Investment Opportunity provided by Gray Capital. Suncrest Apartments is a 140-unit B-class apartment community. There's a light value add component, and the returns are looking incredible. Over 10% average cash on cash, and an internal rate of return projected over 20%. So if you're interested in taking a look at the Suncrest Apartments investment opportunity, it's in Indianapolis, our home market. Check out graycapitalllc.com/Suncrest. Okay, now let's bring Matt Bosnagel in. He's a director of communications here at Gray Capital. Matt, how's the week going? I think this is a very exciting week. How you doing?
It's going great. Like I always say, it's another great week. For this past, really, it's been a great summer. So
yep.
Feeling good.
For the multifamily industry. I would just have to say, if you have been watching these videos, paying attention to the newsletter, we've been tracking this, we've seen, the data points, and now things are, like I said, really materializing. We are seeing unprecedented amounts of growth in the multifamily industry with household formation at a 50-year high. We haven't seen this type of household formation since the early 1970s, and rent growth at an unprecedented level. Certain asset classes and submarkets are growing by 20% year over year. Indianapolis has grown by 9% year over year, and that's 3 times kind of what our long-term average is. So really incredibly amazing. So, Matt, on that subject, bring us in, what's going on in the Gray Report newsletter. And everyone, again, if you haven't signed up for the Gray Report newsletter, graycapitalllc.com/newsletter, and you'll get this every Thursday morning at 8:30. But Matt, what's going on? Moratoriums ending, rents are growing. What's up?
Yeah, that's just one piece of it, but it's a big piece for this week. Another piece that made this week a really good week for me in particular is the embarrassment of riches when it comes to research and reports on the CRE markets and multifamily in particular. We've got solid verifiable data on the first half of 2021, and it nails down a lot of the trends that we've speculated about earlier in the year. The movements from cities to suburbs, we're nearing the end of eviction moratoriums in much of the country. There's bright prospects for industrial properties, even as retail performance kind of continues to ramp up. And the return of the workforce is having this reverberating effect beyond the office CRE market. I kept quiet about inflation last week, but I do want to send out a brief and purely speculative prediction that we will start hearing more about inflation again. If not in the context of the Federal Reserve's continued efforts to keep rates low, then definitely in the context of the bipartisan infrastructure bill that is making its way through Congress. So there's a lot of things going on, and fortunately we have the reports and research that can kind of guide us through and give us a clear picture of what to expect in the next few months.
Yeah. No, it's like you said, Matt, the amount of reports that have come out in the last week or so, they've been really interesting, confirming a lot of the things that, there's been pieces of information we've been kind of piecing together, and some of these reports kind of put it all together, paint a very clear picture of what's happening, right now, really over the last quarter of this year, and gives us a little bit of an indication of kind of where things may be going, at least in the kind of the near short term. I don't know, long term, I don't think there's any way we could see long-term growth like this. But what's happening right now, last quarter and probably this quarter, pretty incredible. To say the least. So, and again, excellent job kind of putting all these reports together, because it's a lot of stuff, and a lot of these guys, they don't always just send them out when they come out. You kind of have to dig for them. We've done all that. Yeah.
And this week in particular, the CRE market is one of the most interesting and really enjoyable markets for me as someone that really reads these research reports and likes to kind of share this information. these institutions like Berkadia and Marcus and Millichap, Cushman and Wakefield, and so on, they put out these reports, and it's really it's really great that this information is available to investors of all
Yeah.
stripes.
Well, they want you to buy some apartments, which
Yeah,
we're okay with that. So I get it, and you do have to kind of be careful sometimes understanding the sources, because they are what they want sales to increase, they want prices to increase. So you have to look at a lot of different sources, making sure no one is kind of fudging the numbers, and that's why we look at so many different sources. But good points. Okay, let's quickly get into a quick snapshot of rates and markets for today. Again, this is Thursday, July 7th, or 7th, July 29th, 2021. The U.S. 10-year Treasury yield, still, very low compared to a couple weeks ago, about where it was last week, though. I'm coming in around 1.25%. 30-day LIBOR, essentially unchanged, 0.09%. The SOFR, very close to zero again, 0.05%. The 10-year Treasury minus a 2-year Treasury spread has come down even less, so that the yield curve has flattened a little bit. It's basically 106 basis points between the two. HUD 223F loans, it's coming a little over 2%, 2.1. HUD 221 D4 coming around 2.75%. Fannie and Freddie, they're hovering around that 3% mark, for like a 10-year term in a decent market if you're a decent sponsor. S&P 500, the stock market has come back over 4,400 on the S&P. And then the iShares residential ETF. Now, this is an ETF that tracks different residential REITs, a broader indication of kind of where the apartment REITs are going in the public market. It's steadily increasing. It's now at $89.70. Spot price for gold, $1,808 an ounce. The steel index coming in at $1,830. And random length futures for lumber, $603, a little stability in both of those commodities. Crude oil, $72 per barrel. Bitcoin and the crypto markets have been improving since the last month, 2 months or so. 39,900 for Bitcoin and 2,300 plus or minus for Ethereum. So that's kind of where the markets are. Obviously, there's a lot of movement. There was a lot of news not a lot of news this week. Even just yesterday, we had the chairman of the Federal Reserve, Jerome Powell, give a press conference giving us an update on markets, which we're going to get into in a little bit, as well as looks like there seems to be some kind of agreement on infrastructure. So, that's another $1 trillion that's going to be pumped into the economy if they actually get this thing buttoned up and signed, because it's not done, but it's another $1 trillion. Let's get ready. So, okay, let's get into the bulk of the report. Let's look at kind of the headline article. It was a great report. This is one of my favorite reports I've seen in a while. It's from Marcus and Millichap, the Multifamily Mid-Year Report. I highly recommend, if you aren't subscribed to the newsletter, hop on over to greatreport.com. We post all of this stuff. It's updated all the time. But if you do get the newsletter, read this report. It's fascinating. It's really good. It's not too long. It's only 4 pages, but I think it adds a lot of clarity to the current conditions. And I've got a couple big takeaways. Matt, what are some of your takeaways that you read in the report?
A lot, and I completely echo that. They pack a lot of value in a short amount of space, and I think they highlight some really interesting trends that may or may not be as apparent in other reports that I've seen this year. Namely, the link between the return to the workforce and rising household formation, which I think is really interesting, right? You're going into the workforce, you're maybe, especially for these millennials that are getting at the peak of home buying age, around like 30 to 34. Last year, maybe they were living with their parents, but there's going to be this huge push to go back to the workforce, to move somewhere else maybe. And then what are they going to do? They're getting a house, they're going to get an apartment. There's going to be more demand for housing as a result of that.
Yeah.
And I also think that they continue to really nail down the suburban and smaller city growth that we've seen too. Those are those graphs that I highlighted in the report itself. But it's very clear that you're going to see this the smaller metros continue to do well. And like I said, I'm still bullish on the growth of small cities. I think that that gateways are definitely coming back, but this is not going to be at the expense of smaller markets. I definitely think it's a both and situation, but I do think that the real advantage of smaller markets in this situation is they didn't have poor performance last year, which kind of gives them a leg up, and they're just kind of continuing this strong performance throughout.
Yeah, I think that's a good point. And those smaller markets are not going to be as overpriced as some of those gateway markets. And we've seen consistent performance. I mean, that's why we like more the secondary and tertiary markets as opposed to the primary markets. Like you said, the big cities are coming back. They definitely have their place, and they're always going to attract people. But a lot of people made the decision that they don't need necessarily, they don't want to live in New York City or San Francisco, and they're looking for smaller metros, and that's why we're seeing, or even Chicago. I mean, you're seeing California, people moving just out of this, or San Francisco, people moving out of San Francisco to San Jose, Sacramento, people out of LA to Inland Empire, people in New York, well, they're moving to Miami, they're moving to Texas, they're just getting out. And then people from Chicago are moving down to Indianapolis. It's pretty interesting. So one of the most fascinating things I saw, so we've got 363,000 units that are expected to be built in 2021. But out of that 363, 1/3 of those rentals are only going to be built in only three metros. Only three metros for 363,000 units. So 100,000 of that's only going to three metros. But what do we need as a country? Absorption is going to be 460,000. Let me find the metric in here, because I know that it's in here. We'll find it in a second. But absorption for this year, and that's how many units are going to be rented. Okay, here we go. U.S. vacancy. So net absorption will total almost 460,000 units. That's up 64%. Absorption is up 64% from 2020. We're only going to build 360,000 units. So we're going to be 100,000 units short. But a third of those units they're building are only in three markets. So there's all these markets that have this huge demand, all this household formation, but there's not enough units. The project we're looking at that we mentioned, the sponsor to Suncrest, occupancy in the market's like 98% plus. There's no new construction in the pipeline.
Yeah.
Rents are going up 12 to 20%, depending on if you're B, C, or A class.
And that's what's interesting. That's the other, we could have focused and spent a whole newsletter recap just on this.
And I think we should. I do want to do like a whole video just recapping this report. It's really well done, and I think it's if you needed some clarity on the condition of the market, the fundamentals, just browse through this report. It's pretty eye opening. So yeah, no, good point. Okay, let's look at what else is packed into the Gray Report newsletter. Again, this really keeps you up to date, and I'd hate for anybody to miss out, especially if you're a multifamily investor, you're trying to learn about the industry, trying to stay up to date. The newsletter is the way to go. And then grayreport.com. It's the just next level. Okay, so Fed, Jerome Powell had a press conference yesterday. We mentioned earlier, and the idea, they're not moving interest rates yet, but they're definitely keeping their eye on things, whether they are going to, they're not even talking about raising interest rates. They're talking about paring back, the purchasing of bonds, which would have an effect on probably raising rates, because obviously there's not as much buying pressure. But really getting down to it is Jerome Powell has basically said the risk, basically comparing the risk of a higher growth and higher inflation versus the risk of falling back and having lower growth, and comparing that to where employment's going to go. The Fed's mandate, it's stable prices and full employment. And they're just not worried about inflation getting out of hand. They really don't think that's going to happen, even though it's elevated, and they acknowledge that it's elevated and it's going to be elevated for a little bit. But they said that's, at the end of the day, that's not going to be that bad, because it's going to get more people into the workforce, and we're going to increase employment significantly. But if we, taper our bond purchasing too quick, if we raise interest rates too fast, and that slows down inflation, we lose that employment growth. That's a much higher risk in their perception than seeing inflation run away. So not anytime soon, maybe eventually, but they want to keep things running hot, and it's running hot. We're at 5.4% inflation right now, so it's moving.
Yeah, that's what the conversation it seemed to be, throughout throughout the summer and the spring is even if there is inflation, it's better that there is inflation and employment than, I guess, low inflation and no employment. Even the worst case scenario, if inflation comes true, the Fed's like, well, that's fine. That's the priority. It seems like at this point.
Yeah, no, I think so. That is definitely the priority.
You saw me I was looking at the side. I have the 10-year treasury, a 10-year kind of look from 2001 to 2020, and really it's never been as low as it has been now.
Well, yeah, outside of last year when it got to point, 0.4, 0.3, 0.4 when it bottomed out last year. So that was crazy. But actual interest rates you're paying on a mortgage, they're still at all-time lows. They haven't really moved.
Well, and what I was thinking of was the conversation of about calling the Great Recession and like the jobless recovery, and it seems like the calculation is much different than it was 10, 12 years ago.
Oh, yeah, absolutely. Okay, let's talk a little about this the eviction moratorium. It's supposed to be expiring in 2 days from now, July 31st. I haven't heard anything specifically saying that they're not going to that they are going to extend it. I would not be surprised if they extended the eviction moratorium again because of the Delta variant. I'm just saying it now, and by the time this gets released, they may have already extended it, maybe not. But we've got a couple articles about the eviction moratorium. We've covered the eviction moratorium quite a bit. We've done videos on it, how it's not really a good thing. Even Slate and Matt, Matt, get into this because Slate's not exactly libertarian.
So Slate's no libertarian, nor are they really conservative. But I think that they came down basically on. I think a lot of landlords would agree with, how they could have stopped the eviction wave is actual, monetary rental assistance, not banning evictions, but actually providing monetary support. And what's happened is there's a lot of money sitting in kind of clogging up the bureaucracy, and it can't get through and to actual people that need it, whether it's because of renters that can't that don't know about the forms, landlords that aren't informed. There's very little communication, and there's I think very little manpower to put these funds that were earmarked for rental assistance. They're just not getting through to the people that need it. That's number one. And I think that, a cynical part of me would say, what if they extend the eviction moratorium because it gives them a little bit more time to figure out how, what to do when it does end. Because I think that the bureaucratic requirements of this situation that they've kind of written themselves into are very significant, and we may only really figure out the severity of the problem once it's over, because it's like another deferment, and it seems like at this point it'd be easier for them. Now I think that it's not without some consequences. But I do think that, from the perspective of a bureaucrat that doesn't want to do extra paperwork.
Yeah. I'm wondering, I wonder if, eventually if this creeps in, some kind of permanent structure for, it's totally unrelated to COVID, because this was never about really COVID. I mean, they said it was, but, not really. And I'm just wondering if there's going to be some other, safety net entitlement that it's eventually going to be put in place that essentially, you can't evict, in some national ban, you can't evict for, these reasons. But on the flip side, but there has to be kind of rental assistance on the other side. I hope that's not the case. That's my concern.
Yeah. So that's
why we need, it needs to end sooner rather than later.
And that's all the cynical, and I really don't think that that's going to happen. But the cynical part of me does think, well, if it's happened before, it might happen again. Now, on the other side, this Globe Street article saying that the eviction may not lead to jump in homelessness. And then that article that we highlighted in our newsletter about a few weeks ago from Reason, talking about that all of the data that was used to support the eviction moratorium, the data says that maybe it doesn't even help or hinder the spread of of COVID. So
Yeah,
there's lots of
all the
reasons
research
for
that
it.
they did to in support of the eviction moratorium is, not, I wouldn't say 100% debunked, but definitely called into question.
Yeah.
How reliable the methodology actually was. So, RealPage has a report. Again, this kind of piggybacks on the Marcus Millichap report. Familiar markets make up bulk of construction activity in mid to 2021, and that's like we were saying. I think a third of all units of units that are going to be coming online this year are in 3 markets. Now, this is more of what's under construction, not necessarily what is going to be delivered this year. But you can see, we got a lot of construction in like familiar markets: DC, LA, Dallas, Phoenix, Austin, New York, Seattle, Houston, Nashville, Denver, Orlando, Atlanta. One of the things I would make everyone watch is this under construction inventory ratio, and so that's under construction and a percentage of the inventory. That's Austin and Nashville, very hot markets, growing a lot. But if you're building 10% of stock, that's a lot. That's a lot of inventory, and even though there's a lot of growth, you can't exceed that growth. And it's been priced. You have to ask yourself, is it priced in? It's like if you're looking at stocks and it's like, there's this great thing's going to happen. There's all this growth. Well, oftentimes, that's already what's going to happen in the future is already priced in to the purchase price, and that's the same thing that happens in real estate. And there's been a lot of piling into a handful of markets. And so what I'd encourage everyone to do is find some markets that are growing at a good rate, that are stable, that have a long-term history of growth, but everyone's not piling in. Unless you are looking to play, you're trying to place, hundreds of millions or billions of dollars, and you have a requirement of you need $1 billion a year of transaction liquidity in a market, which no one really does. That there's better markets with solid fundamentals that just the returns are much better. So it's an inefficient market. Take advantage of it.
Well, and that's one of the things I think I've learned from you, and just kind of looking at the market is yes, there, you can look at big markets and small markets, but you also got to look at how much are they building? Are there too many apartments on the market? Is absorption too low? Because like you said earlier, if that ratio, if 10% is coming on in just a year, then that's a lot of risk. And when you're looking at then those markets, look and try and figure out, is there going to be 10% more apartments next year? Or are they going to really be scraping by and really need it, and which would drive rents up? So I think it's just another calculation that I think is important, especially because a place like Huntsville, that's not exactly a gateway market, but in terms of the ratio of apartments being added, it's huge. It's like over 10%. So I
saw that because there's a lot of good things going on in Huntsville. We've taken a look at it. When I saw that, I'm like, well, the word's out. It's no secret. Okay, Matt, let's get in just quickly. So this report from NAR, National Association of Realtors, July 2021 Commercial Market Insights. I haven't been able to go through this report yet. What's some of the highlights?
I just wanted to touch again. I like this report because it does a really good job of as a brief comparison of the different performance of different real estate sectors. Again, multifamily is seen as like the best risk, the best in terms of risk. It has solid returns, but it also, they also talk about how restaurants are coming back and industrials continuing to perform well. So it's like I said above, it's not necessarily an either or situation when it comes to retail and e-commerce. There may be a pathway out. I think that there's going to be increased competition, and retail still has some challenges up the road, but it does not seem that way for industrial. I don't think that people are going to forget about how easy it is to order things online. And we're just going to still keep that pressure on us.
Yeah, no, I agree. And just look at this. Look at this headline: strongest absorption in a decade with soaring rent growth. Look
It's
at the, I mean, look at this. Look this chart again. I mean, I mean, you can see. I mean, we've had this crisis boiling. Just it's been right under the
yep.
surface. This is why we've been invest. This is why I started investing in 2015. It's similar conditions. We don't have enough housing units. We don't have enough apartments. There's all these renters by necessity. Millennials shacked with student debt. And then these B-class apartments, you're just not building. You can't build them anymore. So there's this huge group of apartments that most people are going to be able to afford, and there's like no new supply. And so like all this has been set up, and now all this movement because of COVID. It's great. So again, just look at the absorption of apartment units, soar, all time high. I mean, again, it's breaking the scale, and it's been moving up because more people are moving into apartments. The demand has been increasing, but now that's just incredible. And then year-over-year percent change in vacant rent for median monthly rent. So people are moving 18%.
Yeah,
it's crazy. So I would take another great report, take a look at. I haven't taken a deep dive. I will. So I appreciate you including this, Matt.
Yeah, and I think a lot of this kind of links up to this short video from Marcus and Millichap again on the housing shortage getting worse.
Yeah,
I think that it's a 5-minute video, but again, just like the brevity of their earlier report that we highlighted, it makes a forceful and really compelling, I think, argument about these massive trends that kind of complement each other and are pushing housing prices upwards. There's a lot of pressure on prices, and it's coming from these long-term, not even pandemic. It was this demographic shift that I mentioned before, and these households that are getting the household formation, the return to the workforce, and the low supply are meeting together. And it's not like supply was going great, before. There was a housing crisis in 2019, and it's just getting worse. And we're approaching this cliff, and there's nothing to support it. So there's going to be, it's just hard not to see a consistent elevated prices, and it's hard to see a bubble. I don't think that it will be a bubble. I think that there's got to be a major realignment that's going to happen, and I only see really prices going up, at least for the medium term.
Yeah, that's a good question, and it's on point because I was on Bigger Pockets. I think it was yesterday, and there was I had made a post kind of about summarizing what I saw going on right now, and kind of like my thesis for investing like right now, based on a lot of reading, a lot of this stuff, especially that Marcus and Millichap report. And someone asked. And I'll just pull it up. While we're here, someone asked, okay, this all sounds good. It resonates with me. But they're like, when I'm talking to folks, other investors, people are saying that we've got to be in a bubble right now. And he basically was asking me, he's like, what do you say to someone who says, we're in a bubble right now because because prices are very high. And when you look at it, the real evidence that people use to point to the fact that we're in a housing bubble is the fact that prices are high. And they're like, well, prices just can't keep going up forever. And like, yes, like that is true. Prices cannot go up forever. They won't. They'll come down. But what's the evidence that you're looking at that's going to point that they're going to come down now or next month or in a couple of months from now? Like, what's the evidence? And again, the really evidence is that things go up, they have to come down. But there's no, but there's like time. You have to put a time element to it. Like, sure, yes, there's like a reversion to the mean. If you imagine if the price continues to go up, that mean changes. That the mean is higher and higher, as prices increase. And so, like, yeah, you're going to have some reversion, which will happen when the fundamentals of demand change, or if there's too much supply, or with interest rates. Rise and it's basically growth between rent growth, household formation, and interest rates. If any of those things change, then like, yeah, we're in a different environment. And someone else on the post said, the only constant thing, he agreed. He's like, the only constant thing is change. This will change, absolutely. And so it's like, point to the evidence point to the evidence
Yeah.
where we're in a bubble, and again, it's or there's going to be a crash, and people say, oh well, there's going to be okay, so the eviction moratorium. Well, we've debunked that essentially. And then people will say, oh well, it's everyone's on forbearance. Well, if you look at those metrics, there's like very few, less and less owners are in forbearance. And that would have been a problem if they were on forbearance, if values went down. But think about how much equity all these homeowners have in their homes. So even if you were in forbearance, your home was worth 270, or $300,000 last year is now worth $350,000. They've gained $25,000 to $50,000 in equity, and so they're good. They're not underwater. And most people, the savings rates are all time high. If you're in forbearance, you got a lot of savings. Wages are going up. So guys, feel free to connect with me on Bigger Pockets. I did post this, and go check it out in the multifamily and apartment investing forum. It's just a quick thesis. It links to a lot of this, some other articles. Just my 2 cents if you want to hear it.
Well,
for me.
And there's dozens of articles. You turn over a rock and you'll find 50 articles that are comparing last year to the housing crisis of 2008 and 2009, and it's different. The upshot to all of them is this is not the Great Recession, nor is it is it a housing crisis?
We should do a couple videos where we just break down some of those housing crash videos, and just to point out how incorrect they are, and not looking at information, or they're looking at old information, or they don't know how to look at, they don't know what it means. Because I see those videos all the time, and I watch them and I'm reading them, because I'm like, okay, I'm going to assume that I don't know everything, and what could I be missing?
Mm-hmm.
And also, understand there's a confirmation bias. Obviously, I want the economy to do well. I want the multifamily industry to do well. True. So there's a cognitive bias that I have. And I'm also, it's like an echo chamber, talking to multifamily investors, get information from brokers, you were getting fed information from, sources that, again, they want the multifamily industry and the housing industry to be successful. And some of these guys are basically pointing to the fact that it's just a narrative from the real estate industry, and it's all the agents, and they want prices to keep going up.
Yeah.
And it's
I think that's a healthy mindset, though.
Yeah. I think it's good. Okay, let's examine that, but then, but actually, let's look at it. Let's actually look at the data from a lot of different sources. That's what it is.
It's not 12 years ago. That's all I have to say.
It is absolutely not. Okay, so Berkadia had a nice report about concessions, and basically saying that concessions, and I've seen a couple different reports recently about concessions. But Matt, give us the lowdown. What's your take?
Yeah, you can kind of see it on this and yes, Class A concessions continue to dominate, but they seem consistently above Class B and C. I think what's more interesting to me is how there's this consistent plateau, and even as rents are rising, the concessions have not kind of shrunk or done anything like that. The rise in rents has far eclipsed the elevation of concessions from the past year. Mm-hmm. But my question is why not just have a slightly lower rent, and why keep those concessions high? That's a question for you, Spencer. But that's just something that is kind of confusing.
Yeah, you could do that. You could we'll just lower the rent, but there's two real reasons why people would rather raise rent and offer a concession than lower the rent. And in one is the it's more of a tactic to eventually get that rent increase the next year. And so you're a resident, you moved in, it's hard to get them to move in, and let's say your market rents for a 2-bedroom is $1,200, and say, well, we're going to give you, $100 off, so it's only going to be $1,100. But hey, by the way, this is a discount. Our market rent is $1,200. Next year, it's going to go up to $1,200. Say, okay, I don't care though. I've got $1,100. I can pay that. Lease renewal comes around. It's like, hey, how do you like your stay? Hopefully they enjoyed it. They're moved in. They don't really want to move. But as we discussed, rent, we're moving your rent just to where market is. And in fact, our market rent is now $1,300, but we're only going to move you to $1,200. Or it's $1,225 and we're only going to move you to 12. So that is a much easier conversation than I'm going to sign your lease at $1,100, and then like when lease renewal comes up and you say rent's going up by $100. What do you mean my rent's going up by $100? Why can't I keep it the same? And so you do want to avoid that surprise. But more practically than even that, having a higher GPR can help on the valuation of a property. If you're trying to sell an asset or refinance an asset, it's easier to look at, this is our market rent and this is our gross potential rent, and this is where we're, going. It's a sense, it's like a pro forma in itself and the target. And ideally, you're going to burn off concessions over time, and that shows, again, like a lender, a prospective buyer of, okay, their pro forma average rent is $1,200 instead of showing that $1,100, and so they're going to say, okay, I can probably hit that $1,200 over the next year, and maybe even move it from that $1,200 to $1,250, whatever their projections might be. And so it's a little bit, it makes your financials look a little better, but it is the same thing. It's just, do you want less in rent or you want more economic vacancy? It's taking it from either place. And there may be another reason that I'm missing, but that's the main reason. So
yeah, just another interesting development, and something that I'm definitely going to keep track of.
Absolutely. All right. Well, that kind of wraps it up for the articles that we're going to cover today in the Gray Report newsletter. Again, though, we didn't cover a fraction of what's in every single week in the newsletter. I mean, again, we basically did like the headlines, but again, I mean, we've got multifamily, the nation, economy. We've got 5 articles there. There's
an apartment list report that is great. You guys got to read it. But we just didn't have time for it.
We didn't have time for it. A lot of really good stuff. Oh yeah, and this is a very good report. I was reading this a couple days ago. It's fascinating. So yeah, again, so a lot of different reports, a lot of great data. Our goal and the reason why we do this is because we want everyone. Information, knowledge is power. Information is power. You get in that the individuals, the people with the best information. Not the most information, but the best information, going to be able to make just better decisions. And so, first we said, we need to have the best information to make the right decisions for us and our investors. And we're like, well, why don't we're putting all this information together. Why don't we share it to our partners, our investors, anybody that's interested in the multifamily industry? And that was the real origin of putting this newsletter together. And it's really, evolved into something that I think is probably the best aggregated newsletter of multifamily information in the world. Matt, what would you say?
Yeah, let's say the world. Yeah,
I mean, I was going to go. Yeah, I would say that. And so then that led us to say, okay, this is good because we had a lot of interest, and we get a ton of people signing up for the newsletter every single day. And it really honestly surprised us how popular it would be. And so we said, let's take the next step. Let's turn this into a website as well. So we're updating this information every single day throughout the day, with as these reports come out, as new articles come out. So you can hop on over to grayreport.com and you can get all the stuff at your fingertips. We also have other videos from multifamily industry podcasts. We've got our stuff, a lot of others. We're pretty we're rising tide raises all ships. We're not just trying to show you our stuff, as well as we sprinkle some of our original content in there as well. And again, and if you're interested in investing in multifamily real estate, wherever you do, I think it's an incredible asset class to invest in, whether you're doing it yourself, another partner. If you're interested in doing it with us, that'd be great. I think you should just do it. I don't care if you do it with us, just do it. But if you can join the Gray Capital Investment Club, you can find that at graycapitalllc.com, or you can find the link at grayreport.com. Ask a couple questions, and I recommend you doing this soon, because we do have that opportunity that we mentioned, Suncrest Apartments. That deal's not going to last long. We've already gotten pre-commitments for it. It's going to go pretty quick. So I would check it out. And if you are interested in again that Suncrest opportunity, all you have to do is go on over to greatcapitalllc.com /Suncrest. And this will let us know that you're interested. Just in your name, your email, phone number. It is only open for accredited investors. So if we didn't say that, or it's only open for accredited investors. But give us your information. If you have an idea of how much you want to invest, let us know. And this we'll shoot you over the full investment deck here. So greatcapitalllc.com /Suncrest. We've got some highlights. It's a beautiful property. If you want to take a look at that little piece I wrote on, kind of the thesis for 2021 that I posted in Bigger Pockets, I've also got that posted on here at greatcapitalllc.com /Suncrest. Again, it's a couple paragraphs, not long, but it's just, if you want to know where my head's at, where the market is moving in the opportunity that we see, check it out, greatcapitalllc.com /Suncrest. If you want to comment on Bigger Pockets, that's cool too. But we don't digress. We progress. Okay,
That's
Matt.
right.
Yeah, Matt. Thanks again. This is awesome. Great episode. Great newsletter. Yep. Great reports. Looking awesome. Can't wait for Suncrest to be down the road and getting closer to close on that property. We're so excited for it. It's a great opportunity. Everybody. Safe investing, happy investing, make some great decisions, do some fun things, spend some time with your friends, family, do all the good stuff, work hard, live your best life as the youth say, I think. So, okay, have a good week. See you next Thursday.